So welcome once again to your financial reporting class. Uh, Today I would like to focus on tangible non-current assets. I'm going to lay down the groundwork for our question practice, which shall be done in a separate video. So let us get on to the outcome. In summary, after learning our tangible non-current assets from the perspective, of course, of financial reporting, we must prescribe the accounting treatment of property, plant, and equipment, borrowing costs, government grants, as well as investment property. So I'm going to start with the objective of IAS 16, which is to guide and inform the accounting treatment of property, plant, and equipment. Property, plant, and equipment includes all assets used in the production or supply of goods or services. Examples here include, and of course not restricted to, owner-occupied land and buildings, machinery, fixtures and fittings, motor vehicles, to mention but a few. Again, in accordance with the frameworks, guidance, these types of assets must be recognized when there is value, economic benefits flowing to the company, to the business, or when there is reliable measurement. I want you to see that the measurement rules: property, plant, and equipment is initially measured at cost. Property, plant, and equipment can be measured at either cost or revalued amount after initial measurement. Okay, we call that subsequent measurement. Okay, so what goes into the cost of property, plant, and equipment? Again, the list can never be exhaustive. All right. First of all, the purchase price of the asset, ex works, free on board, is capital expenditure. Therefore, it should form part of the cost of property, plant, and equipment. Freight charges, delivery cost, non-refundable taxes. For self-constructed assets, you have got labor, legal cost, if you need legal service to acquire an asset, installation costs, testing, pre-testing we call it in financial reporting, restoration and dismantling costs for those assets that require, site cleaning, as well as restoration of the place of operation. You need to include all those so that we can say that all incidental costs, all costs incurred to bring the asset to present location and condition. I'd like to add to that, all costs that add value to the asset should be capitalized. Okay, I'd like us to progress. Now, property, plant, and equipment will be subject to depreciation. Property, plant, and equipment should be depreciated to reflect the loss in value of the asset. Of course, the above avoids overstating profits or assets. Straight line method and reducing balance are the common measurement basis here. Okay, so now we also must brace ourselves for revaluation, assessments under this particular important standard. Revaluation is simply a process of restating the asset carrying amount. Okay, an increase in carrying value means revaluation surplus is set in, where we have to debit the asset account and credit the revaluation reserve account. A decrease in the CV of the asset is called revaluation loss. More technically, we can use that word impairment. All right, so without wasting time, allow me to progress to the other standard, borrowing costs, which provides guidelines on how to treat borrowing costs incurred on the financing of a qualifying asset. What is the thrust of this particular standard? Well, the main idea of IAS 23 is that interest incurred on borrowed funds meant to finance a qualifying asset, of course, should not be expensed, but must form part of the cost of the asset. Must form part, right? Must form part of the cost of the asset. That's what we call capitalization. Qualifying assets have been given there. We have plant power generation facilities. We have got investment properties mentioned, but a few capitalization rules must set in here. So capitalization commences when expenditure for the asset is being incurred, when borrowing costs are being incurred, as well as asset should be prepared for usage or sale. You cannot capitalize interest in the cost of an asset forever. So capitalization ends when the project is interrupted for a long period of time or when the asset is ready for use or sale. Capitalization rates, use the actual rate, a single rate. In the question we shall be able to see, or you can use the weighted average rate if multiple loans were issued or gotten during the year, or interest earned on surplus idle funds should reduce your borrowing costs. Right. Allow me to go to government grants. IAS 28 again guides the treatment of government grants. Now, government grants simply refers to assistance in kind or monetary form given by the government to an organization. Of course, types of grants. We have got what we call capital grants, meant to ideally finance non-current assets or long-term projects. We have got revenue grants meant to finance, working capital. Grant recognition condition. Now, there's no free lunch in the world. We only recognize grants when there is the following in place. Number one, entity will comply or should be able to comply with any conditions attached to the grant, and then the entity will actually receive the grant. There must be a promissory note, there must be a pronouncement, let's say by a government leader. All right. Approaches to the treatment of grants. Okay, what we have there, capital approach. The grant can be credited directly the shareholders' interest, or under the income approach, we can credit grant to profit or loss over one or more periods, based on the useful life of the asset. The standardized 20 again encourages us to use the income approach. Right. Want us to finally close with investment property. Investment property is simply property held for rentals or capital appreciation. Owner-occupied, property remains classified as property, plant, and equipment. Okay, now examples of investment properties have been given there. Land held for long-term capital appreciation. Owned building rather, leased out on an operating lease. Owned building leased by parent to a subsidiary. Measurement of IP, again, initially measure IP at cost. Subsequently, you can choose to use the cost of the revaluation model. Okay, what is important is to be consistent. Apply model chosen to all investments. Okay, to all investments. Okay, so, right. I wanted to also say where an investment property is held under an operating lease, fair value model must be used for all investment properties owned or leased by the entity. Okay, so thank you very much for listening to this theory. Forms the basis for our question practice. I'm going to see you on the other side and have nice time. Okay.